Everyone, this is Rob Roy, and welcome to the Elliott Wave Options U.S. Market Update. Well, we knew this was going to be a big week, and it certainly was. The Federal Reserve raising the interest rates by 75 basis points. There had been some whispers at one time of a 100 basis point increase, and then it switched to where there were whispers of a 50 basis point increase. But the Fed went to 75 basis points, which was priced into the market. So I think that was a little relief to the market. Then we had the GDP report come out, which showed a contraction. First report of the GDP. It'll be revised like 18,000 times the way the government does things, but the first blush is a contraction of 0.9% for the second quarter of 2022, showing that if you believe that 2 consecutive quarters of negative GDP is an official recession, then we are in an official recession. Then we also had, well, we know what the CPI report was. We talked about that earlier. But the Federal Reserve's favorite inflation indicator is the PCE deflator. And that came in at an increase of 6.8% for the month of June, which is the highest 12-month increase since 6.9 back in January of 1982. So those people that are thinking the Federal Reserve may back off after this rate, there's been a lot of chatter on the financial networks that this may be it. The Federal Reserve will do this and then be done. I don't see that. I think the Federal Reserve keeps raising rates and they go too far. I think that's what the bond market's telling us. Let's take a look at the charts. At the time of this recording, it's late on Friday evening, so the futures market is closed. And before we get to the charts, you know how this works. If you like these videos, please hit that like button. Or better yet, hit subscribe and you'll be notified immediately when one of these videos is posted. Thanks, we really appreciate it. All right, taking a look at the charts. Here's the S&P. You can see that the market chose to move to the upside on all the economic news that we highlighted in the intro. It didn't seem so great from an economic standpoint, and the bond market is telling us something completely different than the equities market. So let's go through and look at the charts and detail that. So when we take a look at the S&P, chose to take all that news that I highlighted in the intro from a positive standpoint, and the market rallied. Now you can see that we're actually just a touch overbought with where we closed today from the 10-day moving average. So at this point, it looks like we're destined to test 420. I mean, that's just not that far away anymore. Maybe we get a little bit of a pullback at the beginning of the week because of the fact that we are a little bit overbought. We did have a positive 1030 moving average cross here, so the 10 crossing above the 30. That's a bullish sign from a lot of people that watch that metric. And we also want to take a look at volume. And we take a look at the volume, you can see in today's trade, it was better than yesterday, but still, during this rally point, it's been below average. Now, it's important to note that new impulse moves can start on below average volume. That's not unusual. But for an impulse to continue, are we starting a new 5-wave impulse pattern here? Are we completing a zigzag? I'm going to show you the zigzag in a second. But to continue moving forward, volume has to kick in at some point. So if this is going to propel us higher, we're going to have to see that volume come in, and it'll take that volume to break above 420. And I would submit to you that if the market moved above 420, there'd be so much short covering that the volume would increase, because there's a lot of people that are using that 420 level as their short position because it's been such a strong level of support and resistance. Well, let me go ahead and show you that zigzag pattern that I was talking about. You can see from the bottom of the wave 5 here, there we go, right around a 61.8, just a little bit more than that, around 70%. Well, we went right through the 100% level like nothing. So the next level is normally 161.8. So what we look for to see if we're going to have an extended C wave in a zigzag pattern is one of our favorite confirming indicators, the DMI. Is that showing enough strength that we can move to an extended level, or is the initial level, which the 100%, that's all it needed to do to be a qualified zigzag, was enough? Well, you can see here that the DMI is setting up really well. Looking at the positive directional indicator, it's moving straight up. The negative's moving down. The ADX, which measures the strength of the move, is moving to the upside. However, one caveat here. Our alert subscribers know, because they've heard me talk about it enough, that when you see a DMI that looks like this, it's like in a day or two that ADX is going to be above 20. Let's just go ahead and jump in now. Be patient, wait. You actually have to see that trigger. You need to actually see that ADX move above 20. It's not there yet. I agree. The DMI is setting up ideally the way you would want it to look for an impulse move or a directional move to continue. But we're not there yet. The ADX actually has to break above 20. Could that happen at the start of the week? Maybe, but I already highlighted that we're a tiny bit overbought from the 10-day moving average, so it suggests more of a pause at the beginning of the week. But we'll see how that plays out. But note where that 161.8% C wave extension is, right just above that 420 level. So can we break that level? In the last recording, I asked you which level on the VIX you thought came first, 35 or 20? Well, those of you that said 20 appear to be right. We'll look at the VIX in a moment. But the question I'd like to ask you tonight is, do we break that 420 level? Is that just going to act as resistance and we turn over and we head back to the downside and this is it, just an oversold low volume bounce? Or are we done to the downside? The 61.8% wave 5 extension was it and we're moving higher. So my question is, do we break back below 420 and make a new low, or do we break above 420, which will most certainly bring in short covering, and we extend the rally higher? Which way do you think we go from 420, lower or higher? Be interested in your comments. Please post it underneath this video. All right, so taking a look at the 10-year, I mentioned that the bond market and the equities market are telling us different things. The equities market, you could see, granted on below average volume, but that's a pretty impressive move. You have to be cognizant of that. But when you look at the 10-year, we're moving lower here, and that would indicate that the bond market is saying the way rates are moving down, that this recession is not going to be maybe quite that shallow. It's going to be deeper. In other words, that the Federal Reserve, because if you look at interest rates alone, with the Federal Reserve raising rates, they should be going up, right? If the economy was decent or strong, with the Federal Reserve raising rates, rates should be going up. So the fact that rates are coming down so significantly indicates economic weakness. So the bond market is saying the Federal Reserve is going to go too far, and they're going to throw us into a deeper recession than maybe what some people think. So which one's going to win out, the bond market or the equities market? Because as I mentioned in the intro, there's this discombobulation now. So taking a look here, we're right at a wave 4 level of 38.2%. So we're at a fib level right here. So we could bounce from here in rates, meaning that that's the end of it. And if that is true, so if that's the end of it and rates do start to move back to the upside, indicating maybe the economy isn't as bad as we initially thought it was going to be, or maybe the Federal Reserve does pause sooner than expected, and the equities market, the SPY especially, breaks above 420, now everything's back in alignment then. Or do we continue lower? And this is not the stop. It just happens that the wave 4 is at a 38.2% fib level, and we contract lower here on rates, and the market rolls over at that 420 level and looks to go down and make a new low. That would be back in alignment as well. So one of those two things is going to play out. If we take a look at the dollar has weakened a bit. And, we're just not to the point where the dollar, in my opinion, is indicating too much economic weakness. We're just correcting what was an overbought condition in the dollar. So if we take a look at the moving averages, you can see when we got way up here, this wave 5, which happened to be dead smack in the middle of the target of this tap box, time and price projection, as detailed by this Elliott Wave software called Profit Source. If you want more information about it, go to hubb.com. I think it's the best Elliott Wave software out there. It nailed this for sure on the dollar. So if you're a currency trader, hey, this is something you want to take a look at as well. Moving back to the downside here, we've broken below the 10-day moving average. Are we just coming down to test that 50-day moving average and test that wave 3? That's a possibility. You can see the support there at the top of the wave 3 and the 50-day moving average. And as I've mentioned numerous times, the dollar got too strong. It went vertically up. And I'm always saying that I don't like vertical moves because what goes vertically up often comes vertically back down. It's exactly what happened in the dollar so far. So the key we'll be watching is 105. Can the dollar find support there at the 50-day moving average at the top of the wave 3, or do we break lower? That would be an indication perhaps that the economy was going to weaken more than what may be forecast already in the markets. Let's take a look at the VIX real quick. As I mentioned before, last week's question was, do you think the VIX goes to 35 or 20 first? Well, we broke below 25 because that had become the new level of support resistance, which was amazing to me, kind of the new low recently. And then we broke that level, came back up and tested it. You can see right here that we just tested it perfectly on the 26th. And now we've been moving lower, and it does look like we're destined to at least come down to 20, if not even lower, perhaps all the way down here to this level around 18. So we'll see what the VIX does when it hits 20, but it could go lower. To get down to 18, I think we do break above 420, but we could go up to 420, have the VIX come down to 20, hold their support, bounce back to the upside, and the market roll over. So I think if we're looking at levels to give us an indication of do we break above 420 or not, let's take a look at the VIX. Does it break below 20, or does 20 hold? I think that'll be a good indication. So we look at some of our other markets, looking at the Dow via the DIA. The diamonds moved above 320 pretty significantly there, as you can see. We look at the 10-day moving average, and we're a bit overbought here as well. We're all the way back up to next major point of resistance there at 330. So the fact that we're at a major point of resistance, the previous wave 4 is pretty close here. Wave 5 correction back to the previous 4 is almost complete, and you can see we are extended from the 10-day moving average. So it doesn't look like the market on the diamonds is prepared to break above that 330 level and move significantly higher from here without at least a pause. The Dow needs to come back a little bit, and testing 320 is going to be the key. If it falls back, can it break below 320? Well, then we start looking at a rollover in the market. But if that holds and we move back to the upside, we could be looking at a sprint even higher in the diamonds as well. Looking at the Qs, you can see that they had that wave 5. Talked about this numerous times. 118% extension versus the 61.8 on the SPY and the diamonds. We're back up here at a level of resistance on the Qs. Also looking at the 10-day moving average, you can see that we're overbought in this scenario as well. So all the markets are pretty much overbought, looking for a little bit of a pullback. Can the Qs get above 320? Let's go ahead and move that line up all the way to that wave 3 and see if they can break that level. All the markets are getting close to pretty substantial areas of resistance, and I think, again, that's where volume comes in. That's where the key on the VIX comes in. That's going to give us those two things, volume and the VIX, I think are going to tell us where we go from here in the markets. Looking at the Russell, we're almost all the way back to 190 here on the Russell. We've talked about this trading range of 170 to 190, and we kind of fooled around there at 180 for a little bit, a few days, but 170 was a level of support. Right at the 38.2% fib level, we've broken back up. We're almost back to the previous 4, which is what's supposed to happen. You can see a little minor zigzag working right here on the IWM. So the 190 level is going to be the key. Can we break back above that? I think we need the S&P, the Dow, the Qs, everything will move back together. So isn't it interesting that all of the major markets are kind of in sync? What's not in sync is the bond market and the equities market. We don't always have all of the equities markets in sync either, but they are right now. So taking a look at some of our key stocks that reported earnings this week, everything. And there was good and bad in these earnings reports. Let's be fair. There was some good, but there was some bad things too. Some had good guidance. Some had poor guidance. Some were talking about supply chain issues moving forward are going to affect things. But the market took all of these in stride, and everything was viewed from a bullish standpoint. The market's like, everything bad is good. So good is good, bad is good. That's when you look for things to continue higher. We talked about this in Tuesday night's TradeFinder, looking at Apple. Somebody had asked the question about where we thought Apple would go. And by the way, if you haven't been to a TradeFinder, please join us. We do it every Tuesday night at 9 p.m. Eastern Time. We talk the markets, we look for trade ideas, and we have a live Q&A, which is where this Apple position came from. So sign up underneath this video or go to ewotrader.com. Love to have you in next week's TradeFinder. But we talked about how, okay, 155 is going to be the key right there. That's where we were. And so we pulled back a little bit, and then we sprinted higher. So Apple can do no wrong, it looks like, at this point in time. 155 was the key, so we moved up there. Now, we do have to note, we're still in a qualified wave 5 downward impulse pattern, but we're at 70%, so we're not getting too far away from disqualifying that. But just like the markets, Apple is a bit overbought at this stage as well. So you can see it looks like at the beginning of next week we're going to have at least some sort of a pullback to start the month of August. Now remember, the first trading day of a month at least usually opens to the upside as new money goes to work, but it doesn't mean the entire day is going to finish higher. Just you usually open higher at the open, and then we see what happens from there. Tesla just cruising back to the upside here. Look, we're all the way back, closing right at 891, almost to that 900 level. And looking at the 10-day moving average, a bit overbought there, but a really strong move today. Nearly 6% to the upside on Tesla. Pretty amazing based on what Elon Musk said in their earnings report, just really complaining about the shortage of parts, etc., that the demand is there, so that's what the market is looking at. The demand is there for the cars, but the production is down from what they would have liked because they just can't make them fast enough because they can't get the parts. So the market's chosen to look at the positive on this as well. And then we had Amazon, which reported earnings. And okay, quarter. I mean, again, good and bad to look at in Amazon's quarter. But once again, the market chose to look at the positive side on Amazon's report. But look at this doji. What a perfect doji. Those of you that may be new joining us and not familiar with candlestick charting patterns, a doji is when you have an open and a close that are roughly the same price. So you can see that we opened at 134.90, we closed at 134.95. That's about a perfect doji where the open and close were almost exactly the same. We traded lower, traded higher throughout the day, but again, the open and close were about the same. So we have this kind of a plus or cross-looking signal here. That means indecision. So big gap up also. So pretty impressive that we moved above 120 in such a convincing fashion. So breaking above that level, look at the 10-day moving average. We are way overbought now in Amazon. So perhaps Amazon gives a little bit of a pause. We're not quite up to filling this gap right there, as you can see at 140. So it does look like Amazon gets back to 140 at some point here and fills that gap. But again, can it do it before pulling back first? I don't think so. We're just too overbought looking at where we are and the 10-day moving average here. I think we need a little bit of a rest in Amazon as well. And when you see that, we want to take a look at the volume. Look, that's pretty significant volume. So there was some good short covering as well as buying in Amazon on this earnings report. So just thought I would show you a few of the stocks that reported earnings and how the market just chose to look straight positive on all of them. All right, looking at some of the international markets, the EWA for Australia moving to the upside, but again, still in a qualified 5-wave impulse pattern to the downside. So we can't just say, hoorah, just yet, the downside is over and we're off to the races to the upside. We're not there yet. We've made a nice bounce, but we're at resistance in some charts, mainly in the U.S. markets, and we still have some patterns that are still in really set up qualified Elliott Wave downward patterns that would have to be broken first before we can talk about those markets following suit. We're right at a 38.2% fib level on Australia on the wave 4, and we're also up at a point where we could find some resistance right there around 23. So it's pretty impressive that we moved from 21 and didn't even really blink going through 22, just a really small pullback there for a day or two, and then powered back up. We talked about this in TradeFinder on Tuesday night as well. So looking pretty good in Australia. Look at the EWC for Canada, and you can see very similar, almost well, it is a V bottom right here on this wave 5. Moving back to the upside on the Canadian market, 35 is the key. We've broken above that level. Can we come up here now and fill these gaps is going to be the key with Canada. If we look at the moving averages, a little bit overbought, so perhaps we at least test 35 to the downside, maybe even break it a little bit to come back down to that 10-day moving average. But how we handle 35 is going to be really key on the Canadian market. Look at India just powering to the upside. I've been noting for a couple weeks now that the Indian market has looked as good as anything out there in the markets, and still so. Almost going a bit too vertical now, so we're getting to that point where I mentioned that I don't like it when things go really vertical. We've had a nice move to the upside off the 39 level, and then you can see we're overbought right now and a little too vertical. So maybe India takes a pause here at, just call it a 50% wave 4 correction, just a little bit above that, not quite to 61.8%. We do have major resistance ahead here at 44. If India could continue to move higher from here, it's going to have a hard time getting through 44, at least moving this vertically. And then Germany, look at that. A bounce in the German market. How about that? And we've talked about this so many times about how it's just been so brutal if you've been bullish on the German market, but a break above 23, a key level. The only problem, we got another resistance level right there at 24. Can we get above that? It's going to be right at that 38.2% fib level. But if we can break above 24 on Germany, then you have to start looking at that. You know, maybe this economic weakness thing globally is not nearly as severe as what people are saying. We're not there yet. It's just a possibility. Again, right now we're just bouncing up in wave 4s in qualified 5-wave downward patterns. So let's not forget that when we start looking at all these upward moves. I also thought before we wrapped up tonight I would share with you gold, because we've been talking about so long with the dollar coming down. Why hasn't there been a bid in gold? It doesn't make sense. The dollar moving lower. We should see the metals moving higher. And finally, we've gotten that. We built a nice little base here at 160. But again, we're bouncing in a wave 4. But at least we can say that we have something to the upside here in gold. However, always a caveat, isn't there? Always a however, but we're right there at 165, which could be some resistance here. If we can get through 165, then we have a ton of resistance at 170. So still some headwinds ahead for gold, but it's nice to at least see it moving to the upside. Look at the moving averages here, up above the 10-day moving average, not up to the 50-day yet. We don't have a 1030 cross either. So far we're just getting a bit of a bounce off of that 160 level. But once again, nice to see something on the positive side for GLD. Hope you found this informative. Have a wonderful weekend. Look forward to talking to you again next week. Take care, everybody. If you like these recordings, I'd like to invite you to join our new TradeFinder Live, where each and every week we do a live webinar where we talk about the market, but we also go a little more in depth into the technical analysis system that we utilize to forecast where the market's likely going to go, and also to identify trading opportunities. Get your free subscription today. Take care, everybody.